All right, well, let's go ahead and begin, everybody. Welcome, hope you're doing well. Happy Friday, everyone. Let's see. For some reason, every time I start a presentation, it goes into presenter view on my second screen, and then it blocks the Blackboard window, so I can't see everybody. As you know, homework 7 is due on Monday, so you've got over the weekend to complete working on that assignment. And then the other thing that's in the back of your mind, I hope, and that you're starting to think about and work on is the project. I really like talking about the project, and so if you want to make an appointment during my, well, you don't have to make an appointment during office hours. You can just call me on Teams during office hours, but if you want to make an appointment during another time to make sure that I'd be available, please do take advantage of this time that we've got. I'm happy to look over what you're doing so far, take a look at your spreadsheet, see if I can point you away from any errors maybe that you're going into. There's no excuse for everybody in the class not to get 100% perfect grade on the project. It's a big part of your final grade, and I'd love to see everyone do really well on it. So please let me know if there's anything I can do to assist you. Today we're going to be talking about external rate of return. And during class on Wednesday, we were discussing the internal rate of return. And I hope what you remember from the internal rate of return is that there's a couple of limitations on how it's used. And so this external rate of return allows us to overcome those limitations. So let's review briefly, but before we do, one other announcement. Remember that I told you previously about the Career Expo. So that's happening on October 13th. That's next Tuesday. And this is the sort of thing where just a small investment of your time and effort now could pay a huge dividend sometime down the road. Now I recognize that you've got a lot of urgent requests from your courses, and probably there's a lot of demands on your time in your personal life. And so it's easy to push aside the things that are important and instead just focus on the things that are urgent. But I really would encourage you to avoid that mistake. Just take a small amount of time, make an investment in your future, because going and learning a little bit more about what are the employers looking for, who maybe is offering co-op or internships during this coming summer. Taking a time and investigating the job market now can really pay off in the end if you make a good connection or if it gives you an idea of someplace that you'd like to work someday. So really, I encourage you to register for the Career Expo. You can't just show up on Tuesday at 11. You have to make an advanced registration, and so the full details are at marshall.joinhandshake.com. So please take advantage of that opportunity. All right, so internal rate of return. Let's briefly take a quick look at this example, and remember that the way that we can do internal rate of return is either with goal seek, where we are looking for a certain interest rate that's going to bring balance between the inflow and the outflow, or the automated method, where we're using the IRR function, and it does all of that process in the background for us. Now, the way that we're going to use this internal rate of return is as an initial screening. It will tell us whether or not this piece of equipment is potentially acceptable. If we had multiple alternatives, the restriction with the IRR is that you don't use it for picking which alternative is best, but rather it's only an initial screening tool that will tell you yes or no for the options that are there. All right, so let me just start up a blank workbook here, and let's really quickly take a look at this example. So I'm going to do a print screen so I can paste it over here onto the spreadsheet and see the problem statement while we're also working on the spreadsheet. All right. So we're going to have to start with some guess interest rate. We don't know what the interest rate is at the beginning, so we'll put in a guess maybe of 1%, and then we've got time, amount, PV of amount, and in this, the income is over 6 years, so I'll do 1 through 6. And of course, you're welcome to follow along, and especially if you've got a second screen handy, that makes it easier to do some of these Excel options while you're also watching me demonstrate. And so you can access the second screen like if you watch the lecture on your phone or an iPad and then use your computer for the actual Excel. Or another approach is sometimes you can plug your laptop into a TV screen with an HDMI cable, and then you'll extend the display so that on your laptop you're doing the Excel, up on the TV screen maybe you're watching the demonstration that I'm working through. Having that second screen can make all of this stuff a little bit easier. And you can split the laptop screen, that's right. Sometimes if you've got a small laptop screen, you may wish that you had more real estate. All right, so the equipment is $345,000, and then and it costs $22,000 per year for the next 6 years. And so there's going to be an outflow of $22,000 per year. At the end of the 6 years, it's sold for $115,000, and then it generates $120,000 in new revenue. So what that means is my new revenue is $120,000 for each year, and then I'm going to subtract out the $22,000, and that's presumably operating costs, so that my net revenue each year is $98,000. And that continues down through the very end, with the exception that in year 6 I am also including the salvage value. So when I sell the equipment in that last year, then I'm going to bring in an additional $115,000. Now the definition of the internal rate of return is what interest rate would make it so this initial upfront cost has the same equivalent value in the present as the future revenues. So I need to do the PV function for each individual year at this unknown interest rate. And year will just be whichever row we're in. Skipping over the payment field because we're treating these as individual amounts in the year that they occur. So I will change the formatting of this to currency and then drag it on down, and then we have a total. All right. Remember what we saw in the figure from last time about how interest rate is going to affect the present worth. That if your interest rate is really low, like 1%, it's not discounting these future amounts by very much. And so you'll have a positive present worth. But if you have an interest rate that's really high, like if we had 50% interest, so 0.5, then that results in a negative present value because these future revenues have virtually no value in present terms. And so the goal seek approach is we go here to the data tab, what if analysis, goal seek, and we tell it that we want the total, so set cell the total to 0 by changing the interest rate. And we let that run, and it tells us it's a 22.03% is the internal rate of return. So that's the goal seek way to bring equilibrium. It's a balance in the value of the cost and the future revenue when everything is considered at the same time in the present. Of course, the IRR function equals IRR is even easier, so why not just use it from the beginning? Well, it's good to know what the method is, and so you can't just jump straight to the shortcuts. You have to understand the fundamentals, I think. But we'll check it with this IRR function. You just put the amounts inside of the range, including the amount that's already at the present, and it works out to 22.03%, the same as what we had gotten up here. So should the equipment be purchased if we have a MAR of 20%? That gives us a thumbs up. Yes, this equipment is suitable and it should be purchased. So this is initial screening. But if we had multiple alternatives, we wouldn't necessarily know which one to pick on the basis of it having the highest IRR. Harry asks to see the IRR. You mean the shortcut formula again? The way we do that is just equals IRR, parentheses, And then the prompt that it gives you is just to begin entering the values. And so the range you should define, click at the top and drag downward as you continue to hold the mouse button, and then you can just press enter. You don't even have to do close parentheses. That's just how good Excel is. It's just enter, and then it will return the interest rate. And of course, it may only show you the numbers to begin with, and if you want to increase to see the decimals, then that increase decimal button is here on the top ribbon under percentage. So I click on increase decimal, and now I can see it to the nearest hundredth. Okay, so are there any other questions on this review? Do you remember what are the assumptions built into the IRR? I told you the restriction is that we can only use it for initial screening. But there was one other warning or caution as well. What does it mean, internal rate of return? One of my favorite tools as an instructor is just standing silently at the front of the classroom while it's really awkward and quiet until someone finally feels forced to speak up. But that doesn't work as well when we're teaching remotely. It's just far too easy for you to stay silent and not speak up. So internal rate of return, why is it called internal? What does that mean, internal? Does anybody remember the assumption that's built into the IRR method? Well, unless somebody's busily typing away, I guess that means nobody remembers. The IRR presumes that all of the profit that's being generated is, there it goes, Ethan got it, reinvested. So the money is being reinvested into the same project or a project that has an identical rate of return. So here's what that means, is that you only are actually earning 22.03% if this revenue that comes in, it's not like you can take that money and then go spend it. You have to take this money and reinvest it at 22% for it to receive 22%. So in other words, this 22.03% is an effective interest rate. It's not a nominal interest rate. It's an interest rate that takes into account compounding, and so it's assuming that the revenue and the profits are being reinvested at the rate in question. So that's really important that you understand that restriction. Reinvestment. And that limitation is kind of at the heart of why we have to find the external rate of return, is because we don't always reinvest money back into the original product. So, for instance, this is a famous painting, I've been told, that was painted back in, I think, originally like the early 1900s. But it's kind of famous because in February 2015, this painting sold for $300 million. It's a Gauguin painting, and it was originally sold for approximately $750 in 1893. So if we express that in today's terms, its original sales price was $20,000, which I think maybe even $20,000 is a pretty generous price for this particular painting. But they say, art and beauty are in the eye of the beholder. So the point is, the reason I show it to you is if you were the person who purchased that and then you sell the painting, you can't reinvest your profits back into the same painting because somebody else owns it now. So we wouldn't be able to calculate an internal rate of return for this exchange. We couldn't calculate the IRR because you're not able to reinvest the profits back into the original investment. This is, you buy it, you sell it, and then it's gone. So there are plenty of investments where you can take your profits and put it back in. For example, a savings account. That's the default thing, that the interest you earn on a savings account stays in the savings account and it continues to accumulate interest on top of the interest. But there are other things for which reinvestment isn't suitable, like a painting, or in the case of the hot dog stand. Once you have the food truck, once you have the equipment, then for every hot dog you sell, you may not be able to reinvest it back into your business. You may have to take those profits and put it into a bank account or into a CD or stocks. And so there could be that you're generating profits with one business, and then the profits that are generated are put into a different investment opportunity that has its own rate of return that's separate from the rate of return that was generating the profits. So the IRR can be used for comparing against the minimum, and you use it for initial screening, but you can't use the IRR to compare projects against each other. And the internal rate of return assumes that the profits are reinvested. This external rate of return, the ERR that we're going to be talking about today, allows you to calculate a weighted average rate of return that has an external reinvestment rate. So you have to buy something else with your profits if you've just sold a rare painting, because they can't be reinvested. And so you would have an external reinvestment rate that applies. So the external rate of return is what we're going to be going over today. And the external reinvestment rate that I've been talking about, we assign the variable I sub I. Now this is starting to get confusing because we have I prime, I star, I sub I, capital I. There's going to be so many different letter I's being used as variables. And I'll show you a slide a little bit later that tries to clarify what each one of those different I variables are. But what this means is what I was talking about earlier. In the case of if you have a hot dog stand and you're generating profits, but then you have to take those profits and put it somewhere else, like in a bank or a savings account, that bank or savings account where you put your money, that's the external reinvestment rate. So it is the rate that your cash flows are stored. So here's the method that we're going to follow. And I sent you a spreadsheet template just moments before our class began by email. It's an Excel file that we're going to use to work through today's example. But in that method, we're going to take all of the outflows. So whenever we're spending money, we discount it to the present at I sub I, the external reinvestment rate. And that's known. The external reinvestment rate is going to be a given. The unknown that we'll be solving for is the external rate of return. So there's actually two interest rates in this method. The interest rate that applies to where we put our profits, but then the overall interest rate that takes into account the rate at which profits are generated and the effect of compounding inside of the external reinvestment fund. That's the external rate of return. So in this method, first you discount the outflows to the present at I sub I, and then you compound the inflows. So your revenue, you compound to the future, to the end of the cash flow diagram timeline at the external reinvestment rate. And then the external rate of return is some unknown interest rate that we're going to solve for that establishes equivalence. So by equivalence, what that means is that you'll have to take all of the amounts, the inflows that are at the future, and you'll discount them to the present at some unknown interest rate, and you'll use goal seek to make it so that that interest rate is the one that makes the inflows and the outflows equal. So I've tried to give you a warning, a heads up, when we're going to be covering topics that I've seen students struggle with in the past. Just so that you can give it a little bit of extra focus and attention. This is one of those. And in fact, I'd say this is maybe like the Mount Everest of the course in terms of if you can figure out this method, then everything for the whole semester you're going to be able to figure out just fine. This is as complicated as it gets, and it's not that complicated. We can all understand this. You just really have to focus and practice a couple of times. But get through it, and then everything's going to be smooth. So here is a visual summary of the method. We have some cash flow diagram or a table that has inflows, so those are the revenues above the line, and outflows. Those are the costs that are below the line. So step one was you discount the outflows to the present. So you can see what I've done in step one is all of these arrows that are under the timeline horizon, I've discounted to the present. And the interest rate that I'm using for that is the given external reinvestment rate. With the inflows, the revenues, those are taken to the future at I sub I. So now we've got a bunch of money at the present and a bunch of money at the future. Oh, by the way, I want to give you the warning that if you have amounts that are both inflows and outflows in the same year, only take into account the net amount. So don't take them separately. So this little arrow, for example, you wouldn't take this little arrow to the present and the larger arrow to the future. You'd take the difference between the two, and then since it ends up being a revenue, then that remaining revenue, the net, would go to the future. That's an important point, because otherwise you get a slightly wrong answer. All right, so step three, remember we had all of our revenues in the future, all of our costs at the present. Discount the revenues from the future to the present at some interest rate, some unknown interest rate that we're going to be optimizing and constantly changing around until we get the one that makes it so that the present inflows and outflows are equal, so that they're equal in magnitude but opposite in sign. Okay, so before we get into the specifics, are there any questions about the, number one, the need for this method? You should be able to explain why we do it. You know, why not just always use the IRR? And so you should be able to explain the need for this method. You should also be able to understand for now just like the basic strategy. Even though we haven't done it yet, you can see that the strategy is outflows to the present, inflows to the future, and then make it equivalent by discounting the future revenue to the present at the unknown external rate of return. So the external rate of return is going to be the interest rate we solve for that makes it all balance out and brings equilibrium. So here is, like, if you think in equations rather than step-by-step procedures or a graphical method, if you think in equations, here's the equation that summarizes what we're doing. We're going to be taking expenses, E, expenses through all of the years to the present. So you can see here we're using the find P given F factor. So discount all of the expenses to the present at I sub I. I sub I is the external reinvestment rate. And then you take it from the future to the present. So here the F slash P is saying discount that lump sum of the expenses from the future to the present, and now it's a different I. This is at I prime, which is the external rate of return that we're solving for. And so this I prime is the one that's going to make the left-hand side of the equation equal to the right-hand side of the equation, which is all of our revenues over time being compounded to the future at I sub I. And then, of course, the number of years that you're compounding it to the future isn't n. It's not the year that you're in, but it's how many years until the future. So that's why here it's saying n minus k. It's just how, like when we do the future value on the spreadsheet, we have a reverse time column. That's what this part of the equation is. And so I sub I, this is the main unknown that we're solving for. I prime, the external rate of return. Okay, let me bring open the in-class exercise paper that I hope you have printed out. All right, so here is a cash flow. We can see that there is an initial expense. We've got a couple of years of revenue, then some sort of an expense, maybe a refurbishment cost of some sort, then more revenue, And what we are given is that this is the net cash flow. And so there may have been both costs and revenue in certain years, but we've found the net difference between the two, and this is the net. So these revenues, the positive values in the future, cannot be reinvested into this same business investment. They have to be externally invested, and our external account yields 2.5%. So that's the external reinvestment rate. And you can see in the template that I've provided, the form of it is here on the page, and it's also in the spreadsheet that I sent you earlier. That looks about the same, I think, right? It gives us the idea of how to proceed. We have a time column, the reverse time column, because anytime we have a future values calculation, it's convenient if we have a secondary time column that tells us how many years into the future something needs to be compounded. So you can see that we have the cash flow amount, and I separate it into a column where we write the outflows and another column where we write the inflows, and splitting that apart just so that we can very clearly only apply the PV function to the outflows, and then this FV column is only going to be applied to the inflows. So you find the present value or the future value respectively, discounting at the known external reinvestment rate. So what I'd like you to do is get up to the point where you've calculated the sum of the above, and then together what we'll do is we will fill in these last two parts of the spreadsheet. And you're welcome to move forward. If you think you can solve the whole thing, then that's great. I'll be impressed. But I feel confident that everybody here can do this first part, the first part of the table where you are finding the present value of the outflows at the given external reinvestment rate, and find the future value of the inflows at the given external reinvestment rate. So if you have this that I just emailed you at the beginning of class, then you can use this template, although I don't know why I say 13 years. You're going to have to change it to say 7 years because it's 7 years in our example. Years until year 7. All right, there we go. All right, so I'll pause for a moment and give you a chance to begin. Oh, that's not the right cash flow diagram either. I might have sent you the wrong starting template, but the column titles are the same anyway. Let me just paste this cash flow table. All right, so here's the cash flow table that is the given for today's in-class exercise. Let me give you a chance to get started with that, and then we will get together and see if you're headed in the right direction. Okay, I'm not going to narrate through it, but I am going to start translating the given data into the solution. So if you're stuck on a certain thing, or you'd like to see me solve this rather than working on it yourself, then you can definitely watch while I go through it. Jack asks about the whether you need the negative sign. Not really. You know, the fact that it's called outflow in the column title kind of tells us the direction of the funds, or its sign. And all we're looking for in the end is numerical equivalence. And so you can put it in, but you don't have to. It's already understood because it's labeled as an outflow that it's a minus. Okay, I'm going to stop for another minute here, and hopefully everyone will get to the same point that I'm at now. And if you have questions on how I got a certain thing, or you want to see a given formula, just let me know. But I'll pause for a moment to see if everybody can get to this same point. Okay, so let's go over and make sure that everything is as expected. So we're doing present values and future values. So the 25,000 that is at year 0 as an outflow, when we do the PV function, it stays as 25,000. So that gives us one kind of confirmation things are working okay, is that, you know, it moved 0 years to get to the present, so the amount should stay the same. And then when we're discounting at 2.5%, this $1,000 that is 3 years in the future is worth $928 in terms of the present. So that seems reasonable. You know, it's going to be discounted several years to get it to the present. Now, same thing, trying to analyze what's going on with the future. $5,500 in year 7 is already at the future. And so here in our future value column, the 5,500 is still worth 5,500 because it moved 0 years. That makes sense. This 5,500, if it's compounding into the future, every step, every year that we move it, it's increasing in amount by 2.5%. So that's why it's larger. 5,500 moved 1, 2, 3, 4, 5, 6 years into the future. If you're compounding at 2.5% each year, it's going to be greater than 5,500. So that's, you know, everything is headed in the right direction. It's good to do a reasonableness check, and it seems that it's passing. So the present value is 25,928 of the outflow. The future value of the inflow is $37,031.91. Okay. So you can see here for the external rate of return, we initially have to put in a guess. So let's say our guess value is 1%. So just type in 0.01. Now what you do is with that guess, you're going to find the present value of the sum of the compounded inflows. So this phrase here, the sum of the compounded inflows. What that's referring to is this amount. So let me put a tag on that. This is the sum of the compounded inflows. I mean, and it is, if you think about it, we did the sum, and it's the inflows that have all been compounded forward in the future to times 7. So the $37,031.91, that's the sum of the compounded inflows. So what we're going to do is now we're going to take the PV of that amount using this guess value. Okay, so the PV function equals PV, parentheses, and now it starts to prompt us with the hints. So it says, first of all, what's your interest rate? We'll click here in the external rate of return. We don't have to anchor the reference because we're not going to be dragging this formula down anywhere. You can, it won't cause any harm if you anchor it, but you don't have to. Okay, so next, comma. Now it wants to know how many years. So it's asking how many years should we take the $37,031.91. How many years are we taking it from the future to get it to the present? So it's 7. The future and the present are 7 years apart right now. Next, it's asking what is the recurring payment amount. And it's not that. We're not taking a repeating 7 payments to the present, but rather we're taking a single future value to the present. So as we often do, I'll skip over the payment field with another comma, and I want to know the minus of this future value. Okay, so if $37,000 is discounted 1% per year for 7 years to get it to the present, then that would make it worth $34,000. So what we're trying to do is we're trying to find out keep changing I prime. It keeps changing the external rate of return above until this amount matches the known PV of outflow. All right, so here is the known PV of the outflow. We want this to be the same as that by changing the interest rate. So 1% is too small. It's not discounting the $37,000 enough. Does 2% get me closer? Yes. 3%? Yeah. 4%? Getting closer. So of course, the nice way to do this is with goal seek. Data, what if analysis, goal seek, and so set this to a value of 25,928 and 60 cents by changing the interest rate. Let me see, did I do that one correctly? Yep. Change, yeah, so it's going to be looking down here in this location. It's looking here to achieve 25,928, so I just typed in the amount I'm looking for. And then what it has permission to change is this external rate of return. So as soon as I click OK, it'll start running the numbers, and it finds that it's 5.22%. Did anybody else get 5.22%? If we were all in the classroom together, I'd be circulating around and looking over your shoulder to make sure that you did. All right, good. A couple of other people have followed along successfully. I hope that everybody has. That's great. Thank you. So what does it mean? What does this all mean? Well, you have a company or a business or an investment that's generating profits. It's generating profits at a certain rate, but those profits can't go back in to that company. They have to go somewhere else. So those profits are going into an account that only pays 2.5%. So your business is generating profits at a faster rate than that, but then they're compounding. The profits that have been generated are compounding at a lower rate. So this 5.22% is kind of a weighted average that takes into account both the rate at which your profit is generated, and also it takes into account the rate at which compounding occurs. So this external reinvestment location is factored in as well. Now, this external rate of return, you can compare alternatives with that. If you had an option A and an option B, the external rate of return is going to tell you which alternative is best in a way that the internal rate of return can't. Remember, the internal rate of return is only for initial screening. Well, the external you can use for project selection. And the decision criteria is that if the external rate of return is larger than your MAR, you can accept the project. I guess we should say larger than or equal to, because the MAR, the minimum acceptable rate of return, if you hit the MAR, then you accept the project. So the decision criteria for an external rate of return analysis is if the external rate of return is greater than or equal to the MAR, then select the project. Okay, are there any questions on this example? Well, what I'm wondering now that we've done that together is I'm wondering if you have an external rate of return question on the homework. So let me pull that up quickly. We've got a couple of minutes before we're out of time here. Let's see. Here's the homework. So you've got some bond questions, unrecovered investment balance, which is just like the in-class exercise we had. Here is the internal rate of return question. Use IRR analysis. Okay, question 9, external rate of return. So save the example that you've just worked. That spreadsheet example will hopefully be useful as a guide. It'll refresh your memory on what was the process when you go through and solve question number 9. So this assignment due on Monday does include external rate of return. But now that you've seen it and we've done it together, I think you're going to get through this one really easily. And I even give you this caution. I'm leading you away from danger. Remember, it's the net amount for each year that should be taken into the future. So if there's a year that has both a revenue and an expense, find the difference between the two and only take the remaining net amount into the future or back to the past. That's all I have for you today. Remember that next Tuesday is the Career Expo. Please check that out. Please register. Take a look at the companies that are going to be there. There's something for everyone. And homework 7 is due on Monday. So feel free to give me a call if you have questions, or even over the weekend, if you send me a message, I'll do my best to respond. So that's it for today. Hope you have a good one. Kirsten asks if there is a study group for this class. That reminds me, I took that poll, and I'll email you the results of who said that they want to be in the study group. So I appreciate you asking. I'd forgotten that I'd gathered that information. So I'll send that out right now, immediately after class. Thank you.